Geopolitical risks and ESG reassessment impacting finance. In recent years, the global financial landscape has been shaped by a convergence of two powerful forces: escalating geopolitical risks and the reassessment of environmental, social, and governance (ESG) priorities. What was once a fairly predictable investment environment is now increasingly influenced by international tensions, supply chain disruptions, and shifting political alliances. Simultaneously, ESG investing, once celebrated as the gold standard for sustainable and responsible finance, is facing a period of critical re-evaluation. Together, these dynamics are transforming investment strategies, capital flows, and corporate decision-making across the globe. Geopolitical risks, a growing financial variable. The term, geopolitical risk, refers to the impact of political instability, diplomatic disputes, and international conflicts on economic and financial systems. In today's interconnected world, these risks have a direct and immediate effect on asset valuations, commodity prices, and market sentiment. Heightened global tensions. Trade wars, sanctions, territorial disputes, and military conflicts have become more frequent, making investors wary of placing capital in certain regions. For example, US-China tensions over technology and trade not only impact the companies directly involved but also ripple through global supply chains. Similarly, the war in Ukraine reshaped the energy market, sending oil and gas prices soaring while prompting countries to accelerate renewable energy projects. Economic fragmentation. The era of hyperglobalization is giving way to a more fragmented economic order. Nations are prioritizing self-sufficiency in critical sectors like semiconductors, rare earth minerals, and food production. This reshoring and friend-shoring trend, where companies move supply chains closer to politically aligned nations, reduces exposure to hostile regions but can increase costs and reduce efficiency. Market volatility and investor behavior. Geopolitical shocks often trigger short-term volatility, as markets react to uncertainty by selling off riskier assets. Safe haven assets such as gold, the US dollar, and government bonds typically see inflows. However, prolonged instability can influence long-term investment strategies, prompting asset managers to diversify geographically, increase hedging, and reevaluate portfolio risk profiles. ESG reassessment, from idealism to practicality. ESG investing, integrating environmental, social, and governance factors into decision-making, gained massive traction over the last decade, with trillions of dollars flowing into ESG-focused funds. However, the concept is now facing a period of critical reassessment. Shifting political and regulatory landscape. In some regions, ESG has become a political flashpoint. Critics argue that ESG criteria can be subjective, lack transparency, and sometimes conflict with fiduciary duty when they prioritize ethical considerations over financial returns. In the United States, certain states have introduced measures to restrict ESG investing in public funds, accusing it of being politically motivated. Energy transition dilemmas. One of the most significant challenges lies in the energy sector. While the environmental aspect of ESG promotes renewable energy, geopolitical realities, such as energy shortages caused by conflicts, have forced some countries to revert to fossil fuels for energy security. This tension between sustainability goals and immediate economic needs has led investors to question how strictly ESG principles should be applied in volatile circumstances. Demand for standardization and measurable impact. Investors are increasingly calling for standardized ESG metrics to improve accountability. Without clear, universally accepted benchmarks, ESG funds risk accusations of greenwashing, making sustainability claims that don't match actual performance. The EU's Sustainable Finance Disclosure Regulation, SFDR, and similar initiatives aim to address this, but global consensus remains elusive. The intersection of geopolitics and ESG. The relationship between geopolitical risks and ESG considerations is complex and often contradictory. On one hand, geopolitical events can accelerate ESG adoption; on the other, they can undermine it. Energy security versus sustainability. The Russia-Ukraine war exemplifies this tension. Europe's push to cut dependence on Russian gas accelerated investments in renewable energy infrastructure. However, in the short term, several nations increased coal and oil imports to stabilize supply, decisions that run counter to climate objectives. Human rights and supply chains. Geopolitical risks often intersect with the social and governance components of ESG. For instance, companies sourcing materials from regions with poor labor practices or authoritarian regimes face reputational and operational risks. Western sanctions on certain countries have forced businesses to reconfigure supply chains to align with both ESG commitments and compliance requirements. Technology and data governance. Geopolitical disputes over data privacy, cybersecurity, and artificial intelligence governance are influencing investment decisions in the tech sector. Companies operating across jurisdictions must navigate conflicting regulations while upholding ESG principles related to privacy and ethical technology use. How investors are adapting. The combined influence of geopolitical uncertainty and ESG reassessment has led to a shift in investment strategies. The new approach blends resilience, flexibility, and a balanced perspective on sustainability. 1. Diversification beyond borders. Investors are spreading capital across multiple regions to reduce exposure to localized geopolitical risks. This includes increasing allocations to emerging markets that are geopolitically stable or rich in resources critical to the energy transition. 2. Integrating scenario planning. Portfolio managers are running simulations for various geopolitical and ESG-related scenarios, from sanctions regimes to climate disasters, to test portfolio resilience. This forward-looking approach helps anticipate potential disruptions and identify opportunities. 3. Prioritizing sustainable resilience. Rather than viewing ESG purely through an idealistic lens, investors are embracing the concept of sustainable resilience, balancing ethical goals with pragmatic considerations like energy security, cost efficiency, and geopolitical realities. 4. Engaging with companies on ESG transparency. Institutional investors are pressuring companies to provide detailed ESG disclosures, backed by verifiable data. This not only reduces greenwashing risk but also aligns companies with evolving regulatory requirements. The road ahead. The convergence of geopolitical volatility and ESG reassessment is reshaping the financial world. Investors can no longer treat sustainability and political risk as separate factors, they are deeply intertwined. Financial institutions are likely to see an increased demand for risk management tools, real-time geopolitical intelligence, and ESG reporting systems. Technology will play a key role in this evolution. Artificial intelligence, blockchain, and big data analytics can help investors assess geopolitical risks in real time, track ESG performance more accurately, and adapt strategies dynamically. However, the human element, judgment, ethics, and diplomacy will remain essential in navigating these complexities. The world of finance is changing faster than ever, shaped by shifting geopolitical landscapes and a new era of ESG priorities. The question isn't whether these forces will impact investments, it's how prepared you are to adapt. If you found this breakdown valuable, hit the like button, subscribe for more deep dives into the future of global markets, and let me know in the comments what you think the biggest risk or opportunity is in today's financial world. Until next time, stay informed, stay strategic, and keep your portfolio ready for what's ahead.